Okay, I'm Damien from moneytothemasses.com. The most frequent question I'm asked is, when is the Bank of England base rate going up? Now, to answer that, you need to focus on typically the first Thursday of every month, because that's the day when the Bank of England, the MPC committee, meet and decide whether the interest rate is going to go up. Now, this little seesaw here, what actually happens, there is a group at the moment of 8 people who sit around a room and decide whether the base rate is going to go up, down, or stay where it is. And now, I've drawn this because the most recent vote that we had was slightly skewed to people saying they want to leave it where it is at the moment, which is 0.25%, which is a massively historic low. But there was a bunch of people at this end who started to vote to try and hike it, which actually shook markets. Now, why is this important? It's because interest rates, the base rate, impacts everything in our economy. If you think of our economy as a car, now I've drawn the car up here. If you think that the economy is like a car engine and inflation is like revs and you've got interest rates like gears. Now what the Bank of England is doing is trying to keep our economy ticking along. So if you're driving a car, then your engine is going along nice and ticking along. What will happen is as the revs increase, they will start to go towards that red area. Then what happens, you move up the gears. And so that's the equivalent of the Bank of England moving interest rates up when inflation starts to increase, which keeps the engine from blowing up and actually starts to control inflation. It's just like when you drive a car. So what happens when inflation starts to drop or the economy starts to stutter? They move it down. Now where we are at the moment, we're in gear 1 and we can't go, we're almost in reverse. So what's happening is we're trying to predict when they're going to start moving up the gears. Now if you can drive a car, you could technically drive the British economy. Now what's happening at the moment is this seesaw is moving and we're starting to get looking like we might end up getting a rate rise. We don't know when that's going to happen. Now what you need to do is focus on typically the first Thursday of every month. These meetings happen and they decide the vote. You need to work out this skew of what's happening, so the split. And eventually if it's a majority vote, when it gets more people want it to rise, eventually the rates will go up. Now, where is it going to go? Why is that important? If we're at 0.25%, most people are on their standard variable rate for their mortgage. So if you've got a mortgage, that means you're on their standard rate. So if rates go up, that mortgage lender could push your mortgage rate up. Now, what does that actually mean to you? So if we're at 0.25%, the Bank of England decide to move up just a fraction to 0.5%. Now what that means on a typical mortgage over 25 years, for every £100,000 you borrow, this is the additional amount you're going to go up by, an extra £22. If it goes up to 0.75, you can see the figures going all the way down here. Now, historically, we've been up nearer somewhere like 5%. So you could see if we have a normal interest rate regime, we get back to normality, you're looking at a couple of £100 more a month. And the reason I tell you all this is because there's never been a better time to fix your mortgage, and you should be thinking about it at least, because what actually happens is there's a supply and demand metric that goes on. So typically people will start to think about fixing their mortgage, so they're worried that when rates rise, their mortgage, if it's not already fixed, will start to rise as this SVR starts to go upwards. Then what happens is they will start to react at that point. But what will happen is all the best deals will suddenly be snapped up and their rates will generally go higher and higher on the best buy table. So it means if you're thinking about it, you're better off preempting this move. We don't know exactly when that will happen. Now, the final thing you're probably thinking, I don't care because I don't have a mortgage. But as I said, the interest rates impact everything. Your holiday money is impacted by it, because if interest rates go up, it means that normally the value of the pound will go up, which actually is good news for you if you're going abroad, because it means you could buy more dollars or euros. And additionally, if you're a saver, it means if rates go up, then hopefully at some point your savings rate might go up.